Hey guys, welcome to the Money Mindset. There's so much happening in the world these days. As of now, as of today, there is a ceasefire as far as the war situation is concerned. But these are really hard times for humanity, for civilizations, for markets, for the economy. Everyone and anyone you speak to doesn't know where things are headed. But for now, there is a bit of a relief rally. To talk about that and more, I have Ravi Dharamshi of ValueQuest with me on the show. Ravi has been here before on the money mindset, and the last time around, we were talking about how volatile the situation is. Little did we know that the markets are going to see such a steep fall, especially individual portfolios have had a rough time in the last 5, 6 months. Ravi, thank you so much for being on the show
Thank you. It's
again.
my pleasure to be here.
And it's a tough time for everyone. Luckily, as we speak, there's a ceasefire going on, but who knows, right, with the taco trade?
Yeah. So, a lot of people feel that it is a very unpredictable situation. Yes, it is very unpredictable situation. And when you throw President Trump into the equation, it becomes even more unpredictable. But I do believe if you put a framework around it, it is not completely incomprehensible. First, let's understand the motivation. What is US doing and why they are doing it? The world is moving away from being a unipolar world. What does it mean, unipolar? There was one US hegemon. They were the police inspector, they were the provider of security, they were the consumer, they were the trade partner, everything. And all we had to do was align with them. But now, what has happened over the course of last 20 years is, because of the globalization policies followed, the middle America, which was very manufacturing oriented, has been hollowed out. And secondly, the rise of China, basically. So now we have a rising superpower and a superpower that is kind of plateauing. In that situation, what does the plateauing superpower do? They try to gain leverage wherever they can. So if you see, Venezuela or Iran are the two biggest source of crude oil for China. Their US is essentially trying to get a leverage in those areas, because whichever nation is going and aligning with China are the ones that are bearing the brunt of President Trump's actions. Now, in that scenario, and this is all being driven by the fact that US's debt situation has reached alarming level. If they do not bring the debt level down, I think there will be a catastrophe at some point of time. Now, how do you bring the debt level down? You cannot increase the taxes in US. You cannot, basically bring austerity. So the only way out is for them to inflate, because inflation is a kind of a tax which does not get noticed very easily. So the policies are all going to be inflationary while keeping the interest rates down. So financial repression is what it is called. And once you see everything through the lens of that all actions are from the point of view of regaining that strategic advantage, rebuilding the manufacturing in US, getting that edge over China, then these actions will make sense to you. Not to say that makes it right or wrong, but it just gives you a framework to understand why it is happening. And in that, Iran fits right, in the scheme of things, that US wants to control the choke points that will give them a leverage over the rising superpower, which is China. Now, China has been smart and ahead of the curve for the last 20 years. They have been trying to deleverage away from their dependence on the oil by moving towards renewables. Energy security and energy independence becomes the biggest theme. And that is exactly what China has been following. So, and what it also does is it gives them an extra edge in terms of the manufacturing. China is 40% of the world's manufacturing. And wars between two nations are won by the manufacturing base. It is not exactly won only by the technology. And if you see what in this particular war also between Israel and US, Israel and Iran, what they are trying to do is dismantle the manufacturing capability of Iran to build more missiles, drones, or interceptors. So the war might happen, at a particular point in time or place in time, but it is really won in the manufacturing floors, on the shop floors, where the new drones and machinery is being produced. So US is trying to rebuild that lost strategic advantage while trying to regain some leverage over China. So that's how I see how the world is panning out today.
So now, if this rule based order as we know it has come to an end, and now we are moving to a situation where whoever has the higher negotiating power is the one who's surviving, whoever has a higher pain tolerance is surviving. How do you, as a, as someone who's watching the markets across the board, equity markets, commodity markets, risky assets, how do you approach all of this?
So it is absolutely clear. The rule-based order that was there has moved to some sort of a negotiation-based or transaction-based order, and India will have to find its own feet over here. And in that regard, it becomes absolutely strategic and important that we have our own supply chain resilience. We have our own domestic market. We should have energy security and independence. We should be we should become indispensable to our trading partners rather than the other way around. So a lot of the focus of the government till now has been towards building these resilience. But I think with this particular crisis that is panning out, it has once again revealed the vulnerabilities of India, and I think this will give further push to all these strategic sectors like defense, semiconductor, renewables, uh, aerospace, space. These are the sectors where India needs to build its competency, and we are still lagging behind in a lot of things, unfortunately. But I think this, in my opinion, should ideally be the last oil crisis that India has to suffer. After this, any subsequent oil shock should not matter to India. We should build our resilience before that.
Fair enough. So, it's very clear now that energy supply chains have now become geopolitical weapons, right? In such a situation, how ready is India to deal with this oil shock and any more in future? I mean, what is the situation at
Now,
the moment?
currently, we are not ready at all. So, 85% of our energy imports, rather, our crude requirement is still imported. Uh, However, we have started on the journey to changing our energy basket mix, and renewables has become 20% from the capacity point of view, but from the generation point of view, it's still somewhere between 5 and 10%. So it's still a long way to go. We will have to reach a number somewhere between 50 and 70% of our energy mix should be from renewables. And that, in my opinion, is at least a 10-15 year journey. So we are long way away from that, and that renewables will include not only solar, wind, hydrogen, nuclear, even compressed biogas, ethanol. Everything is a part of the. Everything has a role to play in an economy like ours. For some nations, like say in Europe, wind is a larger part, but we are endowed more with sun. So solar becomes naturally the biggest backbone of our diversification of the energy mix. So one, we need to move away from crude oil dependence, and second, we need to move away from import dependence. And on that front, one of the reason, if you remember last time when we spoke, we were talking about renewables, and everybody in the market was worried about the oversupply situation. But if you realize the strategic importance that now in the crisis that you have realized, it's good thing that at least some of our dependence has reduced, whether it is in terms of electrification or whether it is in terms of ethanol blending. But we are still far away from building that complete resilience. So when a sector is so strategic, you cannot be so focused on the fact that this sector is making money because it has tariff and non-tariff barriers. Basically, there is protectionism which is giving them ability to make money. They are fulfilling a nation's strategic needs. So they need to be allowed to make money so that they can backward integrate and we can have complete dominance over the entire supply chain. Otherwise, it would be the same, right? Right now, we are held hostage. In the fossil fuel era, we are being held hostage by the OPEC nations or these choke points. And in the renewables era, if we don't get complete control over the supply chain, then we will be held hostage by our trading partners. Like if we are dependent on China for all our solar PV module and entire value chain, then we will be dependent on them, and they can have that leverage over us. So it is important to not give them that leverage, and that is why these sectors need to develop within India, even though it comes at a little bit extra cost, because in pure economic terms, it would be cheaper to just buy from China and install it. But if we do that, by saving some money, we would be giving away a huge strategic leverage to a rival nation. So we should not do that. So once you understand that these actions are driven more from the strategic geopolitical strategy point of view, then you understand that one should not be taking an investment call purely based on economics.
Hmm. No, fair point, fair point. I want to delve a little deeper into this entire space. But before that, I also want to understand now, with the escalation of crude and the second order impact that it has on the fiscal deficit and on, balance sheets of companies, etc. How much of that you think is already priced into the market? Because the market is down about 15% from the peak. Do you think there is more damage because of the impact of crude?
So we are right now caught up in a vicious cycle. Our Because crude has gone up and rupee is depreciating. Because rupee is depreciating, FII flows are going out. Because FII flows are going out, RBI is unable to provide the liquidity to the banking system. Because banking system is liquidity deficit, it might hurt growth, and inflation might also rear its head. So we are kind of caught in a vicious cycle, and we need to get out of this. Uh, Coming back to this, how much impact it can have, I believe let's take three scenarios. One is a scenario where the war ends in next 2 to 4 weeks. And when I say 2 to 4 weeks, once these 2 weeks of ceasefire end, and another 2 to 4 weeks, if at all. We have been 6 weeks into this war. So at this point of time, the kind of inventory we have, the availability of feedstock we have, the companies, we can manage another 4 weeks. And maybe this 2 week ceasefire will help us or allow us to build some more of the inventory immediately. And that, I think, maybe instead of 2 to 4 weeks, might be 4 to 8 weeks. So if that is the scenario, that if this entire war ends, we reach some kind of an agreement, settlement in the next 4 to 8 weeks, it will be a transitionary impact. It will not be a permanent impact. It might impact the FY27 numbers for the government, in terms of if we were taking fiscal deficit at 4 or 4.1%, it might actually, 4.3 or 4.4%, we might actually end up with a number closer to maybe 4.6 or 4.7%. It will be a shock that we'll be able to absorb. See, as compared to 2008, when the crude last time went to $140, we are in a far better situation. One, because our economy is now 4x the size. So crude's sensitivity to the entire GDP has gone down. We used to consume about 190 million barrels. Today we consume about 270 million barrels. And today, if the crude goes to $140, it would end up being about 2.5% of the GDP, which is not bad. At that point in time in 2008, when global financial crisis hit, it was almost 6-7% of India's GDP. So as compared to that, we are in a better situation. Our banking system, also the cleanup has happened in the last decade. So the resilience is far higher from the corporate balance sheet, banking system, and central government's balance sheet. But that doesn't mean it will not hurt us. It will hurt us for sure. So every $10 rise is about $18 to $20 billion increase in the cost for India. Now, but we are talking about an annual average number. The assumption before this war started for this year was probably $65-70 in terms of crude price. Now, instead of 65-70, if the annual average comes to let's say $85 or $90, that's about $25 to $30 rise, and that will mean roughly about $50 to $60 billion kind of an extra additional burden on the central government, and that will eat into whatever else we were planning for. So Clearly, the fertilizer subsidy is going to go up, food subsidy is going to go up. Right now, we have cut the excise duty, and central government is absorbing the cost right now. But if it prolongs for a longer period, some of that cost might be passed on to the consumer as well, and that will start hurting the consumer. Probably. So, if the scenario one pans out, which is 4 to 8 weeks, and we are done with the war, then I think it will be only a blip and only a temporary thing in India's overall journey. But if it prolongs beyond that, I think then that is where the challenge really starts coming for India, not only in terms of the balance sheet of central government, but also in terms of the raw material availability, feedstock availability, and then we start seeing layoffs, production cuts, and job scenario becoming even far worse than what it is. Many things start happening if this prolongs beyond 4 to 8 weeks. That's my assessment. So my base case at this point is not that we will have a war that lasts beyond that, because this is not. A lot of people say Russia-Ukraine war, when it started out, it would probably not last beyond 2-3 weeks, but it has all been 4 years now. But one thing people don't understand is that there is no asymmetry over there. It's not Russia versus Ukraine. It is Russia versus Ukraine plus NATO. And that balances the scale a bit. And hence the war can prolong. Over here, it is an asymmetric. US plus Israel is like 100 times stronger than Iran. Yes, Iran has kind of opened up a new front, or everybody's imagination that, if you are going to hurt me, then I am going to inflict cost upon the entire region. I'm willing to, take everybody else down with me, which kind of gives them some leverage in terms of negotiation. But honestly, it's not a sustainable policy. It is only a matter of time when, if they continue this for long, everybody turns against them, and then they will not be able to really
prolong it any
further. So from that perspective, this is a very asymmetric war, and it is in, honestly, nobody's interest to continue. The idea is to get control over the Strait of Hormuz. That's what, as I mentioned earlier in my answer, that this is US trying to gain some strategic advantage over China by getting control over the Strait of Hormuz, so they can control. Now they can control where the Venezuela crude goes. And now they will be able to control where the Iran crude goes as well. With that, China has a little bit of deleverage. As we saw in the trade negotiations also, because of the rare earth thing, China was able to withstand the American pressure. If I was China today, I would be thinking of further diversifying my sources of energy as well, and not give that strategic leverage to US in terms of how the future world pans out. And that is why this rush to build overcapacity on the renewables front, so that they diversify their sources of energy. So anyway, just coming back, I do believe that the scenario one, which is 4 to 8 weeks, and we reach some kind of an agreement and settlement in terms of who will control the Strait of Hormuz or who will get some money out of it. If that scenario pans out, I think we should be fine with a little bit of pain inflicted upon this year's number.
Okay, so that's a very exhaustive explanation, but very important, because you talk about the asymmetry when it comes to the war situation, and I completely take your point. It doesn't benefit anyone, of course. If you look at what's happening with the US, there's such a cost escalation for them in terms of crude, and that is something I guess they did not foresee with the shutting of the Strait of Hormuz. So I guess the disproportionate impact on US is also something that people are feeling in the US itself, right? And that is not going well for the Trump administration too.
So there are only two things which can make President Trump back off. One is the popular opinion turns against him. Which would be the case if the war was to prolong, which would be the case if the costs were to go up. And that matters to him because midterm elections are scheduled for November, and him retaining control of all the three houses is very important for him. Otherwise, he will not be able to railroad the kind of executive decisions as well as the legislation that he has been putting forth. So it is very important, and that is one natural timeline that we have to whatever actions that US is taking. They're trying to achieve something before the midterm election. So he would want to show it as a win over in the Iran war. So it is in his interest also to not prolong this war. But that's one thing. The second thing is the bond market. What happened? When was the second time? When did he back off? In the trade tariff war that broke out, where was when the bond yields started going above 4.5, 4.6%. As I mentioned, the core, the nuclear point of all the genesis of everything is stemming from the fact that US's debt situation is untenable. Now, if the interest cost in US rises, bond market can make President Trump do which no other human being can do, because that will increase the cost for US almost by $1 trillion in terms of the interest payment. And that is what they are essentially, all the actions are towards bringing the US debt to GDP down. But they are trying to pass on those costs to the allies and everybody else instead of trying to take the cost themselves. What is tariff also? Tariff is also something that the US consumer will bear, or part of it US consumer will bear, part of it the trading partner will bear. But what US is saying is that the US government will not bear the cost of it. So annually, I think before the Supreme Court judgment came, I think they had collected some 170, 180 billion dollar, and they were on track to collect 250 to 300 billion dollars. And if that is an annual number, it helps them meet their interest obligations, and it basically gives them more breathing space. So my judgment is because there are only two things which can make him back off from whatever he's trying to achieve. One is the popular opinion, and second is the bond market.
So, can you just explain this bond yield situation to me? I understand why the bond yields and how it would impact the debt, but I don't get how the war situation will is correlated with bond yields.
No. War situation is not
It's
necessarily
not
correlated.
Okay, fair enough.
Only way, there is a second, third order derivative effect, in the sense that if the prices were to go up in US, then Fed will find it difficult to reduce rates. And if Fed finds it difficult to reduce rates, then the interest cost stays elevated. So along with getting control of the these strategic choke points, US also wants to push the costs down, their interest costs down. And for that, it is very important that they keep the inflation in check in US. So there is a temporary episode right now of the crude prices going up, the gas prices in US going up, which is going to play into the inflation, which is why Fed has kept itself on hold. But if that was to come down, then I think that will give more room to Fed to cut interest rate, which is the primary objective of President Trump.
Okay, fair enough. Coming to our markets, I watched a recent interaction that you had on television where you spoke about how you are deploying money in the market now. You are buying in this market. Tell us a little bit about that. Are you putting fresh money to work? If yes, which are the areas that you're looking to buy into?
So, first of all, an honest confession. It's not like we were sitting on a lot of cash. We did not foresee this particular crisis. And but whatever little bit cash we had, we have gone out on a limb and we have told all our clients this is the time to be topping up and not the time to be getting worried about this situation, or worried about the fact that there has been underperformance in the last 15-18 months or no returns in the last 15-18 months. This is the time to be putting money to work. I see this situation as very, very parallel to what happened in COVID. Of course, history never repeats itself, but it does rhyme. So if you remember, in August 2019, government announced a corporate tax cut, and we went from 35% to effective 25%. That was a huge indication and starting of the profit cycle for Indian corporates. However, 6-8 months into it, and we saw COVID hitting in February, and we saw lockdown in March, which kind of came as an interruption. Similar thing I see happening right now also. We had embarked on a GST cut rate, income tax cut rate, rate cut, RBI rate cut. So we were on the verge of reviving the credit growth. Our credit growth, which had gone down to 8-9%, had come back to 13-15%. So we were on the path of recovery before this West Asia crisis happened. So the inflection point had been achieved, but an interruption occurs maybe 6-8 months down the line before the policy actions can percolate down to the ground,
to the P&L.
to the consumer, to the corporate balance sheets. So that is how see it. Now you can, if you rewind back now in COVID, the day the shutdown was announced was the day the markets bottomed. So from that perspective, this is also a very similar situation, that now that we can all quantify how much damage crude can cost, how much raw material supply chain can hurt us, how the balance sheet, the markets are a forward discounting mechanism, and the moment you can get your arms around a particular risk in terms of you are able to quantify how much it can hurt us, markets have already factored that in. So to answer your previous question also, we are down 15%. So we have fully factored in a 4 to 8 week war. What we have not factored in is any prolonging of war. So now what we don't know right now is what the RBI and government's policy action will be. We have seen a couple of steps. One is excise duty cut, and government is saying the initial hit I will take. Consumers and OMC companies don't have to bear that. What RBI has done is essentially control the rupee volatility. Already from close to 95, we are down to below 93. And they have said first impact they were absorbing with the, basically forward short position that they had. They kept on selling dollars. They were keeping the market liquid. But that started impacting the banking system liquidity. So they then cut down the amount of position that banks can take. Earlier, 25% of the net worth they could take in the dollar, arbitrage positions. Now they have cut it down to $100 million. So basically, what they are doing is they are saying that our limit of bearing the losses has been reached. Now corporates need, the banks need to bear a little bit of cost, and their balance sheet are strong. They can absorb some of the cost. So estimates varied between 1,500 to 4,000 crores in terms of how much hit banks will have to take because of this unwinding of position in the dollar. But what we have achieved is that rupee dollar has become stable. Now the next logical step is, if we want this vicious cycle to become a virtuous cycle, we need to attract foreign flows. I don't think now it is a choice anymore. Till now, sorry to say, but this government has been a little standoffish towards we don't need foreign flows, we have domestic flows. But now we have reached a situation where I don't think we can have that kind of an attitude anymore, and which is a good thing, which is a good outcome of this crisis. All participants are important, and FIIs used to own 1/4 of Indian equities. Today that 25% is down to 15%. Almost 10 percentage points drop in the equity holdings from foreigners is not a very desirable thing. Yes, the domestic liquidity has absorbed a lot of it, and we have been cushioned to that extent. But we do need the foreign money to come in, and not only in equities, but in bond market, in terms of NRI money, in terms of FDI. We need all sources of money, and only when we allow free movement of rupee and dollar will our rating can actually go to a higher level, because we have to become fully convertible. If we stay a closed economy, and if we don't have that courage to open up, then we will still be crying that why is our rating on the lower side as compared to some of the European nations which are facing a default situation. It is purely because we are not fully convertible, and only once we become fully convertible will the ratings agencies upgrade us to a much higher level. So from that perspective, I believe that today it is impossible to ignore foreign flows. In fact, we need to lay down red carpet for them. Now, I don't know what steps government will take towards that. It could be an FCNR bond, which was the 2013 playbook, or it could be that we actually level the playing field for foreigners by cutting the long-term capital gains for foreigners, or we completely get rid of LTCG also. I don't. My base case is not that that will happen, but if it was to happen, even if it was for a temporary period of 2, 3, 5 years, that would attract a lot of capital, and that will start the virtuous cycle. So we will get out of this the mess that we keep getting into every time there is a external oil shock. So it is important that we start attracting capital flows. And so the next thing, so we know the crisis, but now we don't know is what the steps government will take, and that is where the opportunity lies. Now if you combine the
So
fact that,
before that, I just wanted to ask you a couple of points that you made here, right? One is we need to attract foreign flows at the moment. What do you think the government needs to do? Three or four things, or rather, how do you think the markets or economy needs to shape up for more foreign flows to come in? Because it's been a very, very dry spell, right? The last 1 year, there's been huge pullout of money from foreign investors. Rightfully so, given valuation, slow growth, other markets looking better, all of that. What do you think is the need of the hour now?
no, so as I mentioned, all sources of capital we need to attract. So we need to provide the foreign capital with the first level playing field. Today, any foreign investor investing in any country in the world does not face long-term capital gains. Yes, we try to distinguish that if the domestic investor is paying, why is the foreign investor not paying? But world over, that is the case. Now, whether right or wrong, that's what our competition is. If we don't provide them with a level playing field, that money will go elsewhere. So that is number one. We need to be at least on par with the other emerging markets, if not better than them, if we want to attract capital flows. Second, we need to get the diaspora money. So last time we attracted some $34 billion in a 3-month time frame when we announced the FCNRB bonds. Something similar this time can draw $100 billion also. Essentially, what we need to do is take the rupee volatility out of the equation. If you can say that this will be the interest, and if there is any rupee depreciation, I will bear the cost, or there is sovereign guarantee for it, then that will attract a lot of capital. And if you give that investor an ability to leverage, so then people 6-7%, and if it is leverage 3x, you can earn 18% risk free, or with the backing of government sovereignty, that will attract a lot of money into the Indian economy. Third, we need to open up at various sectors in terms of FDI. We have already done that, but I think more can be done over there as well, and a lot of it through the automatic route. We have seen some 5-6 deals being announced, but they have all been only in the financial sector. I think far more can be done to attract capital at various sector level. So open up, lay down, and last but not the least, essentially make it easy for the capital to come in as well as go out. Do not have that approach of trying to control. That fear is coming from our past vulnerabilities, that every time we have seen money going out, it has led to some sort of a crisis. If we truly want to have a currency which is a regional currency, if not world currency, then we need to start having that courage to let the rupee float on its own demand and supply. So there are many things, and I mean, I am talking only about the playbooks which have been used. I'm sure government can think far more innovatively and come up with ways to attract this capital. But the important thing is that need is absolutely there to attract that capital.
Okay, fair point. You've made a lot of interesting points. A two-part question on what your view is now on the market. One, do you think we've made a bottom in the first week of April? I know it's very hard to call a bottom, but do you think, given the entire situation, has the market hit a bottom that we hit in the first week of April? And two, going forward, do you think it's still going to be a painful single-digit growth for this market over the next 12 to 18 months? Or are you looking at a sharper recovery, like something like a V-shaped recovery?
So you know what, the way I would look at it is, first of all, I was talking to you just before the show that we become experts at new subjects every few months because world throws at us various things. from the point of view of when has market bottomed, so we do track some statistics. Every time there has been episodes of foreign outflows, the maximum happened in the time of global financial crisis. Now we had our GDP at that point of time was $1 trillion. Market cap was $1.5 trillion. We saw outflow of roughly about 15 to 20 billion dollars, which is roughly between 1% of the market cap to 1.2% of the market cap. So, and it was about 4 to 5% of the foreign ownership. So, if you now look at it from September 24, we have seen about outflows of $45 billion. The starting point market cap of India was $5.5 trillion. And we have seen outflows of $45 billion, which is 0.9% of the market cap. And that is roughly about 5% of the holding of foreign investors. So now this is an outflow which is almost equivalent to the global financial crisis that we have seen. Every time there has been episode of sharp rupee depreciation, it has turned out to be actually the right time for the foreign investor to invest in India. So just to put it in perspective, 2013 global financial crisis, or 2009, March 2009, when the final global financial crisis finally ended, where the backstop was given in terms of sovereign guarantees for the corporates. That is when the markets bottomed. Something similar is going to happen. I mean, I have no idea what steps government will take, but government will take some steps. Now, what I have read in the paper is we are going to give 2.5 lakh crores worth of credit guarantee scheme. Now, if that, along with that, other steps will be taken to stem the outflow, to attract flows to. So now, from a risk reward perspective, from 3 to 5 years, Indian markets are not expensive. Indian markets are factoring in a low growth, challenging economic situation. So the risk reward is in your favor. Now, nobody can predict how soon you will make that return. But if history is any judge, the returns will be, of course, it will be based on what actions government and RBI take, but they tend to be front-ended. So what we expect to happen in 5 years usually end up happening in 2 to 3 years. I believe now the ground is getting laid for the next big run.
But just to play devil's advocate here, in the earlier situations, right, you would also factor in domestic growth, consumption growth. But there as well, there's an issue now with the way AI is taking over jobs and the job losses that we're seeing. Even consumption is something that could get hit. I was reading in the papers a couple of days ago that the real estate sector has gotten very badly hit because not just of the war situation, but also because of how AI has taken up jobs in places like, say, Bangalore, for example.
I'm in 100% agreement with you over there. I think the consumption story is delayed by 12 to 18 months, but I don't think it is dead. It is delayed, it is not dead. Why is it delayed? One, for the fact that AI is disrupting. Let me give you some back of the envelope calculation in terms of what I believe can happen over the course of next 3 to 4 years. About 7 million people are employed by IT services company, BPO plus GCC combined. The kind of productivity gains that we are seeing because of AI in BPO tends to be between 60 and 80%. So when some job that was done by 10 people can now be done by 2 to 3 people. And the kind of productivity gains that we are seeing in IT services, some job that could have been done by 10 people now can be done by 4 to 5 people. So that's 40 to 50% productivity improvement. Now, the job losses might not be exactly equal to the productivity improvement. Some people get retrained in some other way, or there is some bench that the companies will continue to have. And there will be slightly faster growth in the AI related services. So, but still, if you take half of that, that would mean that at least 15 to 20% of the workforce can possibly lose their job over the course of next 3 to 5 years. That means about million to million and a half people losing their jobs. That is going to have an impact on second derivative order impact will be on the consumption, especially in cities like Bangalore, Pune, Gurgaon, Navi Mumbai, where there is high concentration of this migrant workforce, because these are they might be small percentage of the overall consumer of India, but they are the high spender, high propensity, discretionary spend cohort, and that for sure is going to impact the consumption, especially the urban consumption. But what we are probably not able to gauge at this point of time is which other sectors might come up and actually compensate for the job losses that might happen. So on the one hand, IT consultants, IT workforce might find it difficult to retain their job in IT services company. But now every company might become an IT company. Even a small company like ours, we are employing 2-3 people who can understand AI, can understand IT, so that we can do a lot of things in house instead of doing outsource thing. So that will provide some alternative employment to others also, and it will lead to huge productivity improvement. And if you go by the history, productivity improvement does not necessarily lead to reduction in the workforce. It leads to increase in the workload. Uh, uh, Earlier, we used to travel by horse carts. We started traveling by cars. We started flying by planes. It did not lead to it. It led to more and more work only eventually. But there will be a transition period. There will be a 3-4 year transition period where a certain segment of the workforce will find it difficult, and that will impact the interim period of the consumption. So it is delayed. But from the consumption story point of view, I think 12-18 months down the line, we will see 8th pay commission coming into effect. And we will, in my opinion, we will see private sector capex cycle pick up this year. So the biggest driver for the consumption is going to be that we need to see private sector capex cycle pick up. And we were already seeing signs of that, because we need to create jobs. And job growth and wage growth are a more durable factors in consumption sustaining. Once people have that security about jobs and the fact they know that the company is doing well and they will get promoted or they'll get more money, is when the propensity to consume increases. And that I will come with the private sector capex cycle. Private sector capex cycle and real estate are the two. Real estate is essentially household capex. So these are the two things that we need to pick up. Private sector capex cycle will pick up a little bit this year, but the big pickup will happen next year, is what I believe. And real estate this year also might be a slow year, but from next year onwards, I do believe with the interest rates being low and jobs coming back, we will see some pickup over there as well. Again, at this point of time, it remains a little bit of a hope.
Fluid. The situation is fluid.
It all depends on how long this war lasts, because we have the trade agreements in place right now. So the one thing that was missing in the last 4-5 years boom, as compared to the previous boom of 2003 to 8, was the global tailwinds. We need to have a global time period where business can be the focus rather than the geopolitics. And now that we have plugged into the global free trade agreements, I think if we get a 2-3 year period or maybe longer, where we get access to the preferred access to some of these developed market, that would essentially kickstart a new cycle as well. So I remain hopeful that that should happen, and that will negate some of the disruptive things that AI might bring about. And over a medium term and a long term period, I think AI is going to help us leapfrog a lot of technologies, and it will unleash a huge productivity gain in India's economy. So from a longer term perspective, I remain bullish. AI is, but in the short run, I think there is when I say short run, in the next 3-5 year period, there is a transition period, and we need to come up with alternatives for the IT workforce.
Okay, fair enough. I really enjoyed picking your brains in the last 1 hour, but I've run out of time. So finally, I'm going to do a quick rapid fire with you just before we end. Some quick questions, 6 questions very quickly. If you had to buy, sell or hold this market at this point, what would you do?
Buy. Only thing is, it's a 3 to 5 year view. Who knows what's going to happen in 3 months?
Great. If you have 1 lakh rupees to invest right now, where would you invest it, between equities, gold or keep it in an FD?
I am I have and will always remain an equities person. Gold still remains, so maybe for somebody like a housewife who don't understand equities or do not have that confidence to continue with their SIPs in such turbulent times, equities, gold can be an option. But otherwise, equities, I would put 100. Always, I have all in last 25 years, I've always been either 100% invested or 90% invested in equities. Never been less than that.
What is the sector of the next 1 year?
A 1 year is too short a period, but I believe we spoke about some of the themes which will get reinforced. So the medium term and long term implication of this crisis is that we will have to become energy secure, energy independent. We'll have to plug into the global supply chain. We need to re-leverage our economy. We need to kickstart our private sector capex cycle. So any sector that plays into this are the ones to be invested in. And I will never give a 1 year view. It's my next 3 to 5 years view. I think we are on the cusp of starting the next return generating cycle. How intense that cycle is and how long that lasts will depend on the subsequent steps being taken by government and RBI.
So for the next 3 to 5 years, the sectors would be?
So for example, the large private sector capex cycle, where is the capex happening? Data centers, semiconductors, electronic manufacturing, renewables. These are the sectors where all the capex is happening. Now, financial deleveraging, corporate balance sheets is deleveraged. So financials, whether it is the large private sector banks or the NBFCs, then which are the strategic sectors like defense, aerospace, space, where we need to gain, big, or semiconductor. These are the areas where we need to become on par with the world in terms of technology. So I think this is where the focus is going to be.
Okay. Gold and silver are both down 20% from the peak. Do you see a further fall in these asset classes?
See, if slightly elaborate answer, not a rapid fire one, but US wants to bring manufacturing back. They want to become competitive in manufacturing. If they want to do that, they need a weak dollar. If they need a weak dollar, then gold and silver are an anti-dollar play, and it will benefit because of that. So yes, one should. There was I put a tweet out about 2-3 months back that gold and silver will not go up, but that was more an interim thing because there was a literal, almost one-way kind of move in gold and silver. Silver crossed $50, which was the previous all-time high, and it went to $120 in a matter of month. That kind of rise cannot be sustained. So after a period of correction, consolidation, I do believe gold's trajectory largely in dollar terms will remain up because US government wants a weak dollar.
Fair enough. Okay. And final question, any book recommendations, anything that you always tell investors to read? Not the usual suspects, which we know of, but anything new that you're reading?
No, so I think lot of this context and framework that we are using to understand what's happening in the world. We have read books like Chip War. We have read books like Prisoners of Geography. These are the ones that are providing us the context on what is happening and why it is happening. So one can never predict what the next event will be. But if you have that framework of mind to understand, then it will help you rationalize or think rationally in terms of why it is happening. Even though and our job as investor is not to really predict the next event, but to assess the risk reward. And once you understand that odds are in your favor, then you have to start looking, understand which way the tailwinds are going to develop and which way the wind is going to blow, so that you can position your portfolio accordingly. So those are some of the books that I have read in recent past and have really helped me in understanding what's happening in the world.
Thank you, Ravi. As always, it was really a pleasure speaking to you, and hopefully I'll get to chat with you a lot more in due course. But thank you so much for being on the show.
Thank you. My pleasure.